Hello and welcome everyone to another video for CFA Level 1. In today's video, we will be starting with a new topic, and the name of the topic is exchange rate calculation. Now, exchange rate calculation, although is given as a new reading in economics and the last reading in economics, but it is essentially an extension of capital flows and FX market. In this reading, we will just learn 2 to 3 topics, very important topics, both from theoretical, from practical, and from numerical standpoint. Okay, so we will start. So in the previous reading, what we have seen, we have learned about exchange rate. Okay, we have learned about exchange rate. What is exchange rate? Exchange rate is basically price of one currency denoted in terms of another. So if we take an example of India and USA, so we were taking an example of rupees 87 per dollar. This is an exchange rate, correct? Why it is an exchange rate? Because it is telling me the price of dollar in terms of INR, correct? Now we introduce an added twist to this situation. Okay, what is the twist that we will add? Let us add a twist that there are three countries: country A, country B, and country C. Okay, suppose there exists an exchange rate between country A and country B. Okay, A per B, correct? That will be the exchange rate. Suppose there exists an exchange rate between B and C as well. B per C. Okay, but suppose we assume a situation where there exists no exchange rate between A and C. There exists no exchange rate directly between A and C. Guys, do you think this is possible? Guys, do you think this situation is possible? Do you think this situation where there exists no exchange rate between A and C is possible? Yes, it is possible. Why it is possible? It is possible because of the various reasons. One of the major reason is that they are not actively traded. Since they are not actively traded, there is no direct exchange rate between A and C. When this situation exists, okay, when this type of a situation exists, in this kind of situation, in this kind of situation, exchange rate between A and C is denoted in terms of C, in terms of B. Okay, this situation, this situation is known as, or this concept is known as cross rate. Okay, this concept is known as cross rate. So basically, when exchange rate between two countries, when exchange rate between two currencies is denoted in terms of a third currency or a third country, we call it cross rate. Guys, are we understanding? So initially what we had studied interaction between two countries where price of one is denoted in terms of another and we call it an exchange rate. Later on, building on that concept, we introduced a third element where a country does not have an active currency pair In such a situation, their currencies are denoted with reference to a third currency, and this kind of an exchange rate is known as cross rate. Are we clear, guys? Is this concept clear to us? Anything that we need to understand, guys? I hope this is clear. So let us read what is cross rate. Cross rate. It refers to an exchange rate between two currencies implied by their exchange rate with a common third currency. Yes, basically the exchange rate between A and C is denoted with in terms of B. So A and B, sorry, A and C with respect to B, correct? It is applicable when there is no active forex market. Yes, as we have discussed, the primary reason why two currencies might not have a foreign exchange rate is because there is no active forex market. Guys, are we clear? Are we clear with cross rate? Okay. Now we will see one more interesting topic. Okay. Let us take an example of India and USA. Okay. In our entire discussion during the capital flows and during this topic as well, we have been talking about an exchange rate, right? We have been taking examples like 100 rupees per dollar. Whenever we are saying 100 rupees per dollar is the exchange rate, okay, the next thing that we need to understand is what exchange rate it is. What exchange rate it is. Now you must be confused. What does this mean? By what exchange rate it is means whether it is a rate to transact now, immediately, or it is a rate to transact after some point of time. See, this is a very pertinent question that we need to understand. This is a very pertinent question that we need to understand. Whenever I am saying that the exchange rate between India and US is rupees 100 per dollar, okay, the next question is whether this rate will be used for transacting now or whether it will be used for transacting in future. Okay. If this rate is used for transacting now, it is known as spot rate, right? Literally, the English literal meaning spot means immediately, right? Spot means now. If it is a rate to transact after some point of time, it is known as forward rate. Okay. Now, this forward concept comes from derivatives. Okay. And we have done some portion of derivatives in our YouTube videos. You can refer the videos in the library section. Okay. So this forward is the same forward for which we have done the entire class, uh, and that is also uploaded on YouTube. Okay. So when the rate is to transact at some point of time in future, it is known as forward rate. Okay. And when the rate is to be interacted immediately, it is known as spot rate. Are we clear? Whenever nothing is provided, whenever a simple exchange rate like 100 rupees per dollar or 87 rupees per dollar is given, there is a default assumption that it will be spot rate. it will be a spot rate. Okay guys. Okay, so now we have understood that by default, whenever the exchange rate is given, it will be the spot rate. Okay, having understood the spot rate and forward rate, now we will understand one important concept. Okay, where we will integrate spot rate, forward rate between two countries and their interest rates. Okay, what is this concept? This concept is saying that the ratio of forward rate to spot rate will be equal to 1 plus interest rate of the price currency divided by 1 plus interest rate of the base currency. Guys, this formula might seem very heavy, but it is a very simple conceptual concept. Don't worry, we will see it we will understand it one by one. But what it is initially saying is that the ratio of forward to spot will always be same as the ratio of the interest rate of the price currency with that of the interest rate of the base currency. So basically, percentage differential of interest rate between two countries will be equal to percentage differential between their forward and spot between their forward and spot. This will ensure, now the most important line, this condition exists to create a no arbitrage situation. No arbitrage is the catch phrase over here. So basically it is saying that when we take two countries, for example India and USA, the differential between their forward and spot is equal to the differential between their interest rate. Since this is equal, there exists no arbitrage situation between the currencies. Okay, what is arbitrage? Arbitrage is risk less profit. Arbitrage is risk less profit. So basically it is saying that the interest rate between two countries and the forward and spot between the two currencies of the countries will be such that nobody will be able to earn arbitrage income. Guys, we will understand it with the help of an example, don't worry. Let us first study the theory around it. Concept of arbitrage: when currencies are traded freely and forward currency contracts exist. So two conditions: currencies should be traded freely, okay, and forward currency contract should exist. So if the currencies are not traded freely, which means that out of all the exchange rate regimes that we have studied, if the currencies are in a fixed exchange rate or a pegging exchange rate system, then this situation will not exist. Okay, if the currencies are trading freely and forward currencies exist, so it is saying that if the forward currencies are not existent, it is saying that if the forward currencies are also not existing, this condition will not happen. Okay, but if they exist, okay, then the percentage difference between the forward and spot is nothing but the difference between the two countries' interest rate. Very important. Okay, the next line: if the above is not holding, the arbitrage will exist. What is arbitrage? Arbitrage is nothing but risk less profit. Now, how will the arbitrage exist? We will see it with the help of an example. Okay. How does the arbitrage exist? We will see it with the help of an example. Okay. Suppose we consider two countries, India and USA. Okay. Suppose the spot rate is 100 rupees per dollar, and suppose the forward rate is rupees 105 per dollar. Okay. We are taking an example, random numbers we are taking. Okay. Suppose India's interest rate is 8% per annum. So what will be this? It will be price currency interest rate. Yes, India is a price currency over here. So it will be interest rate of price currency. Suppose US's interest rate is 3% per annum. Okay. Just one correction, let the forward be 104 per dollar. Okay. This will be interest rate of the base currency. Guys, yes or no? Okay. Let us first check the condition, whether the condition is holding or not. Okay. Forward by spot is equals to 104 by 100, which is 1.04. On the other hand, 1 plus interest rate of price by 1 plus rate of base is equals to 1.08 by 1.03. Yes or no, guys? Let us do the math. It will be 1.048. Okay. So can we say forward by spot in our example is unequal to 1 plus interest rate of price divided by 1 plus interest rate of base? Correct. Then what do we need to conclude? Since this condition does not hold, arbitrage should exist. Yes or no? Now, how will this arbitrage, or what is arbitrage? Arbitrage is nothing but risk less profit. Arbitrage is nothing but risk less profit. So risk less profit should exist. How will this arbitrage operate? Now we will see how will this arbitrage operate. Operation of arbitrage. See, we had two conditions decided. What was those conditions? First, freely trading currencies and having the forward rate. Okay. If the currency is freely trading, which means borrowing and selling of borrowing, buying, selling currencies are all free. So suppose since this exists, the way we will work is we will borrow US dollar at 3% per annum for a year. Suppose we borrow $100. Okay. Once we have borrowed, bring $100 to India at the rate rupees 100 per dollar. So the total amount that comes to India is rupees 10,000, guys. Now, once this rupees has come to India, invest in the Indian market, India at the rate 8% per annum. Okay. After a year, total amount that I will receive will be rupees 10,800. Yes or no? How 10,800? 10,000 plus 8% of interest. 10,800 I will get after a year. Okay. Convert this 10,800 at the rate rupees 104 per dollar. Guys, yes or no? Forward rate. When you convert this at 104, you have dollar 103.85 you have. How much do you need to repay back? Repay back $100 plus 3%. Repay back $100 plus 3%, which is nothing but $103. So the amount which is remaining with you, remaining amount is equal to 103.85 minus 103, which is $0.85. So this $0.85 is your profit out of all the operations that you have done. Out of all the operations you have done, did you take any risk? You borrowed money from US, you converted it into Indian rupees, invested in the Indian market, took back the money, converted again it into dollars, and then you are left with $0.85 for every $100. Are you taking any risk over here? This 3% is also fixed. This 8% is also fixed. Forward rates are agreed to. Spot rate was there. So this $0.85 is the arbitrage profit that you will earn. Okay. Now, this theory is saying that this situation will never happen. Why it will never happen? See, if arbitrage exists, now the important part you need to understand why arbitrage will not exist. If arbitrage exists, what will people do? People will borrow dollar. From this example, it might be opposite as well. It might be a situation where borrowing in rupees is beneficial. Okay, in our example, borrowing from dollars was beneficial. People will borrow in dollars and people will invest in rupees. Correct? When this is done, it will trigger a mechanism. What mechanism it will trigger? Since people are borrowing in dollars, the interest rate for dollars will rise. Interest rate for dollar will rise. For dollar will rise. And the interest rate for rupee will fall. If a lot of people come together in order to borrow dollar and invest in rupees, then it will trigger a mechanism where your dollar rate will increase and your rupee rate will fall. Interest rate will fall for rupees, and this will continue till the point where your forward and this will continue. It will continue to a point where your forward by spot will eventually become equal to the interest rate differential. Why? Because you will see your interest rate for base will increase and your interest rate for price will fall. Eventually your entire ratio will fall. And see over here, if you look at the ratio, this was higher than the forward by spot. So what will happen over the period when this borrowing and investing will take place? 1.048 will fall, and it will come to a point where it is equal to 1.04, and this arbitrage profit no longer exists. Okay. Since 1.048 was more than 1.04, this was possible. But as soon as people realize this, they will start to borrow dollars, invest in rupees, and the mechanism will start its effect where your dollar rates will rise and your rupee interest rates will fall, and the entire ratio will come down to 1.04. Are we clear? Guys, are we clear with the entire mechanism of how arbitrage exists and how it will never happen in the real world? Guys, are we clear with this? Okay. The arbitrage mechanism is provided as below. We have seen this entirely with the help of an example. Okay. The ratio that we have seen, forward by spot is equals to 1 plus rate of price divided by 1 plus rate of base, is known as interest rate parity theorem. See, forward by spot is nothing but 1 plus interest rate of price currency by 1 plus interest rate of base currency. And this interest rate parity theorem is saying that no arbitrage relation exists. Guys, are we clear? Okay. The interest rates are provided on annualized basis, but if we want to compute the rate for less than annualized period, it has to be discounted. Very logical thing. All the interest rates that we were talking about is annualized, but even for a period less than the 12 months or less than annual, we'll have to discount it. If actual forward rate is less than the rate of interest rate parity, borrow base currency, otherwise borrow price currency. This is important. This guideline is important. Why? Because in your CFA paper, there will be no one telling you that which currency you should borrow, which currency you should invest. In your CFA paper, you will be given forward rate, spot rate, and the interest rates of the currency. You will be asked that what will be the arbitrage profit. Okay, you have to identify in which currency the arbitrage profit will come out. Okay, so in that situation, this is a very important guideline. If actual forward rate is less than the rate as per interest rate parity, borrow base currency, otherwise borrow price currency. Very important. What is actual forward rate? Actual forward rate is what is given you in the question. What is rate as per interest rate parity? Rate as per interest rate parity is this. Are we clear, guys? Okay. Forward premium, forward discount. It is calculated always in relation to spot exchange rate. Okay. Forward discount. What is forward discount? If forward by spot minus 1 is less than 0, it is known as forward discount. If forward by spot minus 1 is greater than 0, it is forward premium. What is forward premium? Logically, simply, if forward is greater than spot, it is a forward premium. If forward is less than spot, it is a forward discount. Simple as that. If forward greater than spot, then it is forward premium. If forward is less than spot, it is forward discount. You don't need to think anything else. Forward premium means forward is in premium. Forward discount means forward is in discount. Simple as. Okay. Forward exchange rate quotation. It is expressed as the difference between spot exchange rate and forward exchange rate. Nothing to worry about, simple theory. Indicated as point. So forward exchange rate is always indicated as point. We will see how. The unit of point is the last decimal in the spot exchange rate code. For a spot currency quoted up to 4 decimal, such as 2.3481, each point is 0.0001. So basically, whenever you are quoting forward exchange rate points, the decimal in which it is quoted will be equal to the number of decimals in which spot exchange rate is quoted. So if it was 2.34, it would have been 0.01. Since it is 4 places, it is 0.0001. Okay. One example is given over here. AUD/EUR spot rate is given as 0.7313 and 1 year forward rate is quoted at plus 35. What is plus 35? Can we say, since it is plus 35, it is forward premium? Since it is plus 35, it is forward premium. If it was minus, it would have been forward discount. Now, since it is given plus 35, how do you calculate the 1 year forward rate? Forward rate is nothing. Forward rate is nothing. It is equal to spot rate plus the points. Now, the rule to convert the points is that the number of decimals is there in the spot rate, same number of decimals will be there in the forward rate. See, 0.7313, which is the spot, plus 3.5 divided by 10,000. Why? Because there are 4 decimal places in spot. If there were 3, it would have been 1,000. Are we clear, guys? Similarly, in percentage as well. This you can, do it in your homework. So in this topic, what we have seen, in this topic, we have understood first about the cross rate, then we have understood about spot rate, then we have understood about forward rate, then we have seen interest rate parity theorem, then we have seen how do we quote a forward rate in the market, and then we have seen how do we convert a spot rate into forward rate using the funds. Guys, are we clear? So I hope this session was helpful. What we will do in the next class, we will take up with some of the practical questions of exchange rate regime and this topic, so that you are able to better understand these concepts. Okay, till then we will meet and happy study.